tell the audience about how you got started in real estate.
Welcome to the Masters in Real Estate podcast with your host, Tanner Webster.
So I got started in this business raising money for Inland, who is the largest 1031 exchange sponsor. And I spent about a decade with them just traveling around the country raising money from financial advisors and kind of learning how the business works.
And then what'd you do from there?
Well, I kind of saw a big gap that was in the marketplace. A lot of the people that were raising capital for real estate didn't seem to have a firm grasp of how cap rates worked, interest rates worked, et cetera. So I went back to school and I got a master's degree with a concentration in real estate finance, which is actually where I met Michael Episcope. He and I both went to the same school here in Chicago, DePaul University. And so I met Michael there, finished school, and then went and got the CFA designation afterwards. As I thought more and more institutional investors that are allocated to real estate typically will have chartered financial analyst, that's doing the due diligence and stuff. And so I wanted to be able to speak their language. And so that helped quite a bit, just in terms of kind of overall knowledge of finance, portfolio allocation, understanding risk. And, everything's kind of come together. I've been doing this for about 17 years, not exclusively on 1031s, but that's been a big part of my career: opportunity zones, private placements, sidecars, REITs, evergreen funds, et cetera.
Okay, so then when did you get to Origin? This was 2022? Or when did you start there?
So Origin, we just started up this platform, 6 months ago, really. So I started with Origin pretty recently, and the genesis of it was working with Michael to kind of say, I feel like Origin is missing something in the product lineup where you've got allocation strategies to equity and debt. You've got a tax advantage solution with opportunity zones that's really taking off and your investors are loving it. And there seems to be a missing piece of 1031 exchanges. I think the general thought process was, we don't want to be in the DST space because they're transactional, they're fee-laden, et cetera. And so the idea was, can we come up with a better mousetrap? So in essence, there's nothing wrong with Delaware Statutory Trust as a wrapper. The problem is essentially how they're sold, how the capital is raised, how there's so many hidden fees. And so we thought if we could just cut through all of that, we can make a better product for investors, go directly to investors. And so we've been working hard behind the scenes for probably a little over a year and getting this up and running, and we'll launch our first DST in July. So we're ready to launch.
Can you talk about the fee loads that you see in other DSTs? Because I've just heard it anecdotally, by the time you invest, it's almost like you buy a new car. Like by the time you drive it off the lot, you have like 30% depreciation. Yeah. And I've kind of heard similar things about the DSTs. So can you dig into a little bit of that fee load and the hidden fees that come with those?
Yeah. Yeah, and that's, maybe one of the issues of our industry. I mean, they're not necessarily hidden. They are there. It just depends on what due diligence the investor is willing to do and the time and basically sophistication of reading one of these private placement memorandums, which can be upwards of 200 pages. If you do go through there, I read tons of them, so I pretty much know exactly where to go in a PPM. But you can essentially find the sources and uses. And one of those uses is going to be purchase of real estate. So you'll see the actual price of the building that's inside the Delaware Statutory Trust. And a lot of times you'll see that of the entire deal, it's 84% of the purchase price or 89% of the purchase price or something like that. In our deal, I believe it's 97% of the purchase price is allocated to real estate. And remember, a lot of it is just unavoidable closing costs. We have to pay attorneys, we have to pay for title, we have to pay for consultants as part of closing a deal of that size. And so so to answer your question, I think if you're looking at the total fees on equity for a brokered DST deal, you could be upwards of 15%. And when we say hidden, yes, they are disclosed in the private placement memorandum, but for the most part, if somebody does $1 million investment into a Delaware Statutory Trust. Their statement is going to show $1 million. Their dividends are based off of $1 million. So in a lot of cases, they don't know that $150,000 is gone in fees, and it's not buying real estate. So the net asset value, essentially, of what you bought is $850,000. And so just imagine the growth of that property just to get back to the $1 million that you paid, plus hopefully some sort of profit. So we've cut the fees down from, let's call it, 10 on the low side to 20 on the high side, maybe an average of 15 down to 1 to 2% front end load.
Yeah, I feel like when you're hitting a 15, 20% fee load just off the bat, you're better off paying taxes and just keeping that money in your checking account, basically. So I think I mentioned it a little earlier. I'm working on a deal with a landowner who's just a farmer, and I don't know if I know anyone who hates paying taxes more than a regular farmer. And so let's say I advised him, maybe not advised is the wrong word. Maybe I told him about Origin and the Origin exchange. How would that work for him? So I buy his land from him. How does that work?
Yeah, so that good question. That's a question we get all the time about the logistics of it all. And if people are familiar with a 1031 exchange, there's really not much different in doing a 1031 exchange with a syndicator like Origin versus doing your own 1031 exchange. Of course, there's many, many rules you have to follow. And so I don't think we have time to kind of go through all the rules on this particular discussion, but you would follow all those same rules. Namely, you would put the money with a qualified intermediary. So before you actually close on the land and that farmer receives his proceeds, he would establish a qualified intermediary account. At closing, the money would go to the qualified intermediary. So that would sort of establish his time frame to complete the exchange. And so most people are familiar with 45 days to identify a replacement property, 180 days to complete an exchange. It's the exact same thing with a DST. So you could think of us as the only difference is the DST is what's the like kind replacement property. In fact, these things are light speed. So if you're doing a 1031 exchange on your own, you need 6 months because you have to find a property. I actually just got off the phone before we did this discussion with the guy who said his last day to identify a replacement property is tomorrow. The deal that they were going to close on fell out, and they had planned on buying it. And luckily, it fell out in their 45-day window. So I just sent him an email half hour ago, and I said, here's how you can identify our VST. So we could save a lot of these things because our deals are sort of prepackaged and turnkey. And so if it was something he was interested, say your closing is, September 1st. You could actually set up the QI in August. You could get all of the paperwork to Origin in August. You could say, here's how much I want to invest. Then we hold that paperwork in good order. You're just subscribing to our offering, no different than any other syndication. September 1st, you go to close. The money goes to the QI. The QI takes a day or two to wire it to us. And so you're literally out of the market for like 2 days. That's a really, really simple process.
And as far as the mechanics behind this, do you plan on just always having properties available? Like you guys are just buying every 3 months or something like that? Or is it, you can exchange into the DST and then the DST will buy something 6-7 months later? Like, how does that work?
Yeah, that's right. So the DST will never buy anything else. The DST is a standalone vehicle. In fact, there are certain rules that guide the Delaware Statutory Trust, the 7 deadly sins you may have heard of, where you can't take capital contributions, you can't improve the property, you can't renegotiate the lease, you can't refinance the debt. And so as you can imagine, these have to be very core, stabilized assets that we acquire. From that regard, it makes it pretty simple. If we go out and buy a $100 million apartment complex and we put a first mortgage on it for $50 million, we'll go out and raise $50 million of equity from our 1031 exchange investors. Once that $50 million of equity is raised, that deal is completely sold out and there's no other equity available. So we'll be on to the next one. And so from our perspective, we're keeping a constant pipeline in our sales system to kind of know how much equity we should have out in the marketplace. It's significant. I will tell you, just for having launched this fairly recently, we've got a lot of demand. And so our deal team, like I said, we've got the first deal that's coming out in July. We expect that to close fairly soon, a month or two maybe. and our deal team is right behind it with other assets that they're looking at. So let's just say we do a deal a quarter, $30 to $40 million of equity. And so we'd like to have 120, 160 million of equity, per year.
How are you sourcing those deals? You're in a couple different markets, mostly across the Sunbelt, right?
That's right. Yeah, mostly across the Sunbelt. When you talk about how we're sourcing deals, I think it kind of gets into the overall Origin architecture and our use of multilytics and data, and we could kind of go down that direction. For this question, though, we're a very data-driven company. We've got deal officers in our major markets, and we want to buy where the rent is going to grow. We only focus on multifamily. That's all we do at Origin. And so we're based in Chicago. We don't buy any properties here. That's where our headquarters is. But we've got an office in Denver. We've got an office in Dallas, Nashville, and Charlotte. And we have deal officers all throughout those markets. And so as we're looking in Raleigh and Nashville and Charlotte and Tampa and Austin and Dallas and Nevada and Phoenix, we see just about every deal that hits the market, that's within our box. Right now, I think in our internal deal tracker, we have 108 deals that we're sort of following, that we'd be kind of interested in, working towards. So it's just using the data to show you where you want to be, and then using the ground level, deal officers to see every deal that comes through the market. We know all the developers, we know all the brokers, and people like and want to work with Origin. So we see quite a few deals.
And I want to talk about the Multilytics platform, just because so many sponsors they'll underwrite a deal and they'll say, yeah, rent's going to go up by 3% a year or something like that. But I remember it was probably early 2022 where Origin, I saw it on like Facebook or something, where you guys thought rents were going to go down by like 2 or 3%, while everybody else was underwriting 5, 6, 7, 8% rent growth. So let's talk about the Multilytics platform, how it was developed, and how you guys utilize it today.
Yeah. Good question. And we could do a whole webinar just on Multilytics, bring over some of the people from that side of the house. So I'll give a very introductory level kind of explainer of it, but I think you're right. We saw such robust rent growth that pretty much everybody just thought it was going to, keep going. And obviously, we're not 100% sure of this, but we believe we're the only major real estate outfit in the multifamily space that was predicting rents to decline in 2020, 2023 and 24. And so that data has proven to be pretty accurate. So right now, everybody's talking about AI, and it's kind of the hot new topic, but this was developed many, many years ago. And the idea was just to solve a problem. So there's information that we take in, and all these commercial real estate companies take in, and just like anybody else, we could back test it. And so we get the data from these sources, we input it into our models, and then we can kind of look back and say, how predictive was that in determining whether rent was going to go up or down by 3% in a given market that we're tracking? And the data that we were using could predict accurately whether rents were going to go up 4% of the time. It was wrong 96% of the time. And so as a business, I think Origin looked at it and said, we can't really do anything else until we fix this. How do we do it? So let's sort of get creative. And so I built a machine learning model that would take in 3 billion data points a month. And this would be maybe one-way U-Hauls going to a place, population growth, new permits for apartments, but scraping the web for all of this data. And the nice thing is, again, the data can be back tested. And so now that we've kind of applied Multilytics and said, what are the markets that we now think rent is going to go up or down by 3% annually? Multilytics is 95% accurate in determining whether rent is going to go up or down. It's just a model we continue to invest in. It's a model we continue to improve. And when we first started, it took in 3 billion data points. Now it takes in 9 billion data points every single month. And so there's markets that we will add. There's markets that we will drop. We just added Salt Lake City as a market.
Hey, look at that.
It's down. Absolutely. Yeah. Your backyard. Right. And you kind of know why. I mean, so Like that's when you talk to the people in those markets, they say, oh, I get it. That's a place that we would be. Well, that's where the data drove us, right? And so now our Denver deal officer is going to be out in Salt Lake City looking at all those deals. And so the model's proven to be pretty accurate. It's a pretty big advantage for us in terms of proprietary data and driving it sort of to the right markets.
I want to back up a little bit because we were talking about the Origin Exchange platform, but we didn't really. I kind of got sidetracked there. So we were walking through that example of the farmer. The farmer goes and they enter the DST platform. Let's walk through the life cycle of their money thereafter.
Yep. Yeah, no problem getting distracted. The multi-lytics is pretty cool. People tend to get distracted by that a little bit. It's the shiny object over here. But so life cycle and talking about how it works, et cetera. So, I mentioned the logistics of how you get in the fund. You subscribe to the offering, money goes to QI when the cash goes into the DST. And so you are an owner of that, particular asset. We've got a deal that we're not quite under contract yet, so I don't want to kind of share all the details, but a property down in Dallas, that'll be our first DST launch. It's just in the northern suburbs where we see a lot of growth. It's about a $60 million asset. We're about 45% loan to value on it. So we're going to raise 34 million of equity in that deal. And so if your farmer client came in, their cash would go to the QI. Now they would own a piece of that property. And so they would receive all of the cash flow from that asset. They would be able to offset that cash flow with depreciation. They would receive any appreciation in the asset as we can continue to manage it over time. And I think one of the things that's unique about Origin is sort of our exit strategy. And so when you do a normal 1031 exchange, the idea is currently it's kind of like a swap until you drop. And that is to say, we'll take this property and we'll sell it to a third party buyer, maybe 5, 6, 7 years from now. And then your clock starts again. And then your clock starts again. And your clock starts again. Well, sometimes that does actually work out pretty well where you put in $1 million, it turns into $1.2 million and you roll it into a new deal. More principal, more cash flow, et cetera. A lot of times it works out fairly poorly. 2023 was actually one of those examples where a lot of people were exiting out of older deals that were maybe 60% LTV with a 7% cash flow because they bought them a while ago. And then you come into 2023 with the interest rate spike. And so nobody could finance deals. And so you're coming into a market where it's like, all I have is 35, 40% LTV deals. The cash flows are in the threes. I don't want to swap, but you have to. The deal sells, and so you're forced to kind of sell. And so, we wanted a structure where people would sort of be off that roller coaster and just not have to deal with real estate anymore. And so one of the potential exit strategies for our platform is for the DST that you're currently in to be acquired by our Income Plus fund. So Income Plus is our flagship real estate fund. And anytime 2 years after you've been in the Delaware Statutory Trust with Origin, the Income Plus fund has the right to acquire that asset. And so if they choose to exercise that option, Income Plus fund chooses to exercise that option, they will buy out your interest in the DST. Now, instead of giving you cash for your interest, they'll give you partnership interest. And so that exchange of partnership interest is tax-free or tax-deferred under Section 721 of the tax code. So you hear people talk a lot about a two-stage or UPREIT, and UPREIT is kind of synonymous with a 721 exchange. So you sell your property, you do a 1031 exchange into the Delaware Statutory Trust. You'd own that for at least 2 years. After 2 years, if the Income Plus fund decides to exercise its right of first refusal, then you'll be uprooted into the Income Plus fund. And there will be no more swapping. There will be no more idiosyncratic risk of a single asset. So the reason people like that, if you kind of think about your portfolio and your investment life cycle and going along your time frame, one of the things that we talk to clients about is like diversifying out of your single stock, right? You might have worked at Microsoft forever. Your spouse worked at Microsoft. Your options are in Microsoft. You have 80% of your stock portfolios in Microsoft. Why don't we diversify it into a tech mutual fund? So relying on a single asset in finance is called idiosyncratic risk, and you want to eliminate that in your portfolios whenever you can. And so what this does, it takes you from a single asset to a broadly diversified portfolio across all the target markets that Origin likes. It's also diversified across the capital stack so that we can invest in core, core plus, lending, development, pref equity. And then, of course, it's, diversified geographically plus the number of properties that's in there. So a nice kind of set it and forget it exit strategy where you offload all of your active management to us, exchange up into high quality real estate, and never have to deal with a tenant phone call for the rest of your life.
I mean, that sounds pretty nice. So what is the exit strategy thereafter? Is it just live in a fund for indefinitely, or are there liquidity options? Like, how does that part work?
Yeah, that's a good question. So anytime you're talking about real estate ownership, if you ever want to take possession of the proceeds, you're going to pay taxes. So whether you do a swap to you drop DST, whether you do a 721 UPREIT with Origin, whether you do your own 1031 exchange, if you ever want the principal, you're going to pay taxes. And so with the 721, what I like about it is that we take a completely illiquid asset and make it semi-liquid. So once you roll into the operating partnership units, the Income Plus Fund has a redemption schedule, which you would now be a part of. And so, of course, it's gated. We own buildings, and so we can't be 100% liquid all the time. But we can redeem up to 5% of the outstanding units per quarter and up to 20% of the outstanding units in a given year. So that doesn't mean 5 and 20% of your holdings. What it means is if we've got $1 billion fund, we could redeem $50 million a quarter for a maximum of $200 million per year. So should you need to dip into your liquidity down the road, it's nice to have that redemption schedule where you can send us in a form and we can buy back your shares. Of course, that would be taxable to you, but it's nice to have that liquidity option down the road should you need it. Depending on your portfolio, a lot of people look at their, what they're doing now, the other assets they have, cash that's built up, and say, I don't ever want to take principal out of this. I just want to let it grow forever. I want the cash flow off of it forever. And one of the tenets that we hold most strongly to at Origin is that one of the best paths to wealth is to keep your cash invested for the very long term without the transactional costs of fees and taxes, and just let it grow. So if you just kind of keep it in there for the rest of your life, it really cleans up your estate, because now you're passing on an operating partnership unit to your beneficiaries. It's easily divisible. Nobody has to do any work. Nobody has to manage the properties. And then, of course, you get the same stepped up cost basis that you do with real estate. So from a planning perspective, it's nice to say, I just want to hold this for the rest of my life. But should you need liquidity, it's got a redemption schedule that would be better than a swap to you drop, or better than owning the real estate yourself.
And how does that value like every quarter? Is it just based on a net asset value schedule? Like we think, this deal has gone up and this deal's gone down. Like how does that work at a high level?
Yeah, so we value the portfolio on a monthly basis, completely transparent. We put it out in every kind of update. We list all of our assets, what their value was last month, what it is this month, how we came up with the valuation. And then we have it audited by a third-party appraisal company on an annual basis. And so, the debt instruments we can value pretty easily. They're basically just based off of the interest rate market. Equity's a little bit more, complex, it depends on comps, cap rates, occupancy, how it's doing. And there's sort of a range, and we usually kind of pick the mid-level of that range. But yeah, we just declare net asset value on a monthly basis.
Yeah. You mentioned there's a couple different instruments that you use. There's prep equity, there's regular equity, and there's mezzanine. How do you look at like the allocation of each of those? Like, I think you guys were really smart in 2020 to 2022 or 3 about not doing any direct deals, and it was all through the Income Plus Fund as prep equity or mezzanine. How do you guys decide on how much you allocate to a given space?
Yeah, I think it's about risk versus return, and opportunity costs, and liquidity and cash flow. So I think it all comes into it from a portfolio management perspective. One of the things about Origin that I love is how transparent we are. So we do probably a quarterly update on the Income Plus Fund. And by the way, the Income Plus Fund is not just for our 1031 exchange platform. The Income Plus Fund is an ongoing perpetual fund where investors can just invest on a monthly basis. It's open to new investors, and we take in cash investors every single month. And so frequently on our updates, Mark Turner, who's the head of portfolio management, will get on and talk about those type of things. So why did we switch from this asset class to that? But I think in general, if you think about real estate as sort of a fixed income asset, well, what happens to the value of fixed income bonds if interest rates go up? The NAVs go down. And so with so much, with inflation being so high, everything was pointing to interest rates not only going up, but going up significantly. And so there was a lot of funds that are sort of tied to a core investment thesis where in 22, 23, they just had to keep buying and buying and buying. And then when interest rates went up, their NAVs got hit really, really hard. And so Origin, I think to its credit, sort of saw that and said, okay, if interest rates are going to go up, well, then we should be lenders. And so we switched, more to the debt side. We switched more to the pref equity side. We did some development deals and bought some land that we thought was at a good price. And so it's all about, what is going on in the current economic environment and how should we deploy new capital? And so if you look at sort of returns, if you take maybe non-traded REITs or private core funds, in the last 12 months, I would say they're down on average, between 5 and 12%. The Income Plus Fund is up 4.5%. And so it's a 14-point delta in some cases because we're able to pivot and move. And I think that's a really good talking point for the 1031 exchange strategy, because if you do a 1031 with Origin exchange, you sort of date the DST, you're in it for 2 years. And if the option is exercised, then you're going to marry the Income Plus Fund. You're going to be in it for a very long time. And so there's two things that we like about, that strategy compared to some other 721s that are in the market. Number one, we don't have to just stay in core. We can be flexible depending on what's going on in the different economic environments as we move forward. And then number two, we're focused exclusively on multifamily, which we think is the most resilient asset class that has a long sort of bull run in front of it, in a place where, you'd want to be for the long term.
And you covered a lot there. Going back to the pref versus equity versus mezzanine, do you personally have like a favorite strategy? Would you like to see more of one thing versus another, or do you think it's pretty well balanced?
Inside of the Income Plus Fund, well, of course, you have to sort of limit it, right? Otherwise, a certain strategy can just take over. For example, we're limited to 20% ground-up development. Ground-up development is nice. It is riskier. Costs can go up, and it doesn't provide any cash flow while you're building the property. So, we want to have a blended sort of rate of return, and I think favored investments are better for sidecars, right? It's like, oh, I really love that. I love this particular market. I love this particular strategy. Let me find a sidecar that's there. When you invest in the Income Plus Fund, I think we're not trying to hit home runs. I think we're trying to hit singles and doubles. And as you know, it's like, if you hit singles and doubles, every once in a while you hit a home run. And so we're going to do that. But if the core assets that we put in Income Plus Fund can be earning high single digits, if the core plus stuff can be earning 10, 11%, if the development deals that are sort of the jet fuel can be earning 18, 19%. On the lending side, we're seeing things in the 10 to 12% income stream. So you kind of blend that together, and we want to get our investors back to a 9 to 11% annualized rate of return is kind of our target for that fund. Right now, we're paying a 6.3% distribution. So if you look at maybe a 6% distribution and 4% growth, that would be kind of what we're looking for. Well, what our investors are more interested in the Income Plus Fund is tail risk. And they're just looking at something where I don't want to lose my money. I spent my entire life creating this wealth. I want a safe place to put it that's going to provide me tax efficient income and growth, and something that I can just forget about and know that it's going to be in good hands with Origin. So not a particular asset class that or strategy that I think is better than the other. It just depends on what is in the portfolio currently, what complements what's in the portfolio, and how we protect the downside for the investors.
Okay. And I guess stepping back a little bit more, you guys have grown such a large platform of like 3,800 investors or something like that. And you're doing deals that are, I'm going to say, pretty complex with all the, like open-ended equity vehicles are pretty complex from a tax and accounting standpoint. If you were going to advise me on how to grow such a large platform, how do you think about that? Like you do the content marketing, which I watch like all of the YouTube webinars. So I've obviously learned a lot from that, but how do you manage such a large platform?
Yeah, my advice would be like anything is to crawl before you can walk. And Origin didn't start out with this many investors. It's a really good, founder story. And I will tell you what attracted me to Origin was Michael Episcope and David Shearer, who founded this company. They made their wealth as derivatives traders. And so, kind of, let's call it by their mid-30s, they had enough wealth to just, kind of not work anymore. And they got together and they said, well, how do we protect and grow our wealth? Like, let's look out in the marketplace and find deals. And they really didn't like what they were seeing. They thought fees were too high. They didn't like the alignment of interest. And so they started this as sort of a family office to invest their money together to find deals. And so friends and family started seeking them out and, trying to, invest in more and more of their stuff and growing. And I think it was the way they think about the markets is just different. I think building multilytics is part of it. They didn't just go to brokers and buy the next deal on the street. The underwriting was thorough. The amount of work and time and effort that went out to finding actual deals, flying out to see it, scraping through the PPM, turning deals down that didn't work, I think made a really big difference. And that's why, according to Preqin, our returns are in the top decile for multifamily private real estate investors. And so we went from, 2 employees to 5 or 6 employees to 10. And then, you kind of learn along the way. You mentioned that we have 3,800 investors. We now just hit 4,000. We have 4,020 investors or something like that, individual.
That is insane.
Yeah.
That is awesome.
It's something we're really, really proud of. And in addition to that, we have 80 registered investment advisor partners who allocate their clients' capital to Origin funds. And that's a part of our business that's growing significantly. And talking about learning, it was the investors coming to us and saying, do you mind if I have my financial advisor look at this? Well, of course not. Well, my financial advisor is an RIA. And so, we got so much kind of like reverse demand where the RIAs would underwrite it and say, man, your fees are so much lower than what I'm currently using. Can I use you for my other clients? And so we sort of grew like that and realized we needed help on that side. So now we have a full team that just covers registered investment advisors from an investor relations perspective. We have a full team that just covers individuals from an investor relations perspective. But I think more than anything, and this may be sort of anecdotal, it's what attracted me to Origin, but I think the honesty and just kind of the truthfulness of like Michael and Dave and the other senior leaders of Origin coming out and talking about a deal that maybe didn't do as well as they thought. Nobody's perfect. And I think people just want to invest with firms that are going to make the right decisions given certain economic situations. And I think that's what comes across. We're very thoughtful. We think about the markets differently. We really, really care about each and every one of our investors, and we put our money in these deals. So Michael and David have invested over $80 million of their own capital across the Origin deals.
Oh,
exactly.
man.
Yeah. And so where their wealth is. And so we're very comfortable going to other investors and saying, this is where our founders' wealth is. They're the ones, underwriting the deals and looking at them on a daily basis. So we think, this is a good place for part of your wealth as well. And then you try a little of everything. You don't know what works. Our webinars have been pretty good. When we launched our Origin Exchange webinar, we had over 1,000 people signed up for it. We've got a new webinar coming out that talks about, what's going on in the multifamily market. We've got Jay Parsons, who's going to be a guest host on that. We have almost 1,000 people registered for that. And so I think it's having something to say, like, this is what we think about the market and this is where we're putting our chips. We think you should come with us. And then whether you're right or wrong, you come out and you talk about it afterwards and say, here's where we were right, here's where we were wrong, here's where we're going to go in the future kind of thing. So that honesty and that trust has been built up over time, and it's been great. Our investor base just keeps growing.
Well, I think you're very right in terms of thoughtfulness with each market. I mentioned earlier that I think a lot of guys just kind of throw numbers on the wall and hope that they stick. But what markets are you most excited about over the next 3-5 years?
Oh, it's got to be Salt Lake City.
Yeah, of course. Why not? So,
well, Salt Lake is a really good example. We see paradigm shifts, right? You see the kind of work from home is a permanent thing. Back when I was growing up, apartments were sort of a punishment. It's like, oh, I'll live in this apartment for a couple of years, cinder block walls, coin laundry. The landlord never fixes anything, and someday, hopefully, I could buy a house. That's kind of what it was. And apartments have really increased in quality, and now you've got 9-foot floor to ceiling windows, stainless steel appliances. They're bigger, better construction materials. You've got a golf simulator in the property. You've got Starbucks and laundry in unit, smartphone to unlock the doors. I mean, it's just lightning fast Wi-Fi, co-working space. And so the idea is people are saying, I don't want to mow the lawn. I don't want a 30-year mortgage. I don't want to do any landscaping. I'm busy working anyway. I go out with my friends. I just don't want to deal with the hassle. And then now I like kind of living in this place. People are getting married later, so you can get roommates. It's a more fun place to live. And so there's this paradigm shift where people aren't in apartments for a short period of time and then looking for a home. There's a lot of people that are choosing to live in apartments for 10, 20, 30 years or their entire life. And so we are very under delivered in terms of, kind of those units and apartments in a place that we just, are very, very bullish of, kind of going forward. And I'm not sure if that answered your question.
Yeah, I guess something along those lines. Can you mention some of the stuff that beyond multi-Linux, like what you guys look for in deals? Like, are you looking for a minimum unit count? Are you looking for a specific location, different amenities, school districts? Like, how does that really look? And I'm sure it varies between each market. But what does like an ideal apartment complex look like to you guys?
Yeah, that's a really good question. I think everything comes together, and there's a lot of variables. Like you mentioned, school districts. Well, school districts, in different states are different. There are some places where it's just you have to be in the private schools. So when you talk about, jobs, are people working from home? Are they going downtown every day? Is this going to be the path of growth? Is there a highway coming through? All real estate is local, and it's not just local to the state or the city. It's local to that particular side of town or that, particular, there's 2 gas stations, both across the street from each other. One goes out of business, one got a line out the door. And it's just because the ingress and egress is better on this side of the street. And so to us, that's why we, have all of our deal officers in their markets all the time. I was down at a conference in Las Vegas, which is one of our target markets, just speaking to a group of CPAs. And in the last day, our deal officer was down there, looking at a project, and Michael was at the conference. So he went and, looked at the property as well. And it's a deal that we really like. Some of the LP equity on it was maybe underfunded, and I don't know if it's totally distressed, but we could come in and sort of be later capital to come into that investment. It's infill. It's a beautiful location. The comp spec out, very, very high quality materials. And so it's a matter of, is what you're buying today going to be worth more in the future? So much that goes into that. It's the price is what you pay, but the value is what you get. And so we're looking for deals where there's a story to it, where there's a reason that people are going to want to pay more rent to be in that property for the next 10 or 20 years. And there's just so much that goes into it. And it's why our sidecar sells so well. When we bring out a sidecar and we talk about this particular property in Colorado Springs, or this particular property in Las Vegas, or this particular property in the suburbs of Atlanta, here's why we bought it. Here's how we bought it. Here's how we found it. Here's the new employers that are coming into the marketplace. Here's the population growth over the last couple of years. Those typically move extremely quickly because people see what we see, and that is the kind of the story behind that asset. But it's a tough question to answer. Like in general, it just comes down to that specific deal.
That was a tough question. I agree. I want to bring it home on where you guys think the market is headed. You know, we've obviously had a difficult 2 years, 3 years maybe. What do you think's on the horizon?
Well, I think I can give you kind of Origin's answer. We're kind of all over about that. You know, if you're unfamiliar with Origin and where we stand, we've got a great webinar on our website just called 2024 Predictions with Dave Shear. And we kind of lay out what we think is going to happen. And then next year, he'll kind of review those answers. But we think interest rates are higher for longer. It's where we are, it's where we've been. As we discussed earlier, we were one of the first to predict that rents would sort of start to subside and fall in certain markets. And everybody says, well, there's just cranes everywhere. There's like people are building all these apartments. Aren't you worried about the oversupply? And worry is one word. We track it. You know, we want to be aware of, you know, what the supply is. But one of the most important distinguishing features, especially in the multifamily space, and we could talk about some other things if you want, the office space and what's happening in retail. And, you know, we track all that and I track all that stuff personally, but multifamily is all we do. It's what we're focused on. And if you look at the delta between the amount of deliveries and the amount of starts, it's the highest gap that it's ever been since 1976. And so we feel like what we're seeing is a very short blip in the radar of rent sort of correcting. Because, yeah, maybe Austin is down 1.5% year over year. But remember, Austin had a lot of years of 5, 9, 13% rent growth. And so it's sort of abating or subsiding a little bit. But what you're going to see is because interest rates went up and because construction costs have gone up so much, you're going to see not very many starts in the multifamily space. And so as that supply gets absorbed, because people are going to keep moving to Austin, people are going to keep moving to Phoenix, people are going to keep moving to all the markets that we like, we're very, very bullish for the next 10 years on being able to raise rents in the multifamily space in those markets that we like. In terms of the overall market, it feels like we're in a recession. You know, sellers aren't really capitulating. There's still a pretty big spread between bid and ask on all the asset classes. There's a paradigm shift in office where work from home is a real thing. And we've got an oversupply in a lot of the major markets, especially major markets that people are just moving out of in general. So that remains to be seen, sort of what happens there. Beginning of the year, everybody thought there was going to be over 100 basis points of rate cuts. Remember, 6 cuts throughout the entire year. We haven't seen one.
I remember this. Yeah.
You know, and it all happens pretty quickly and it's all sort of baked in. And so they say it takes about 24 months for interest rates to be baked in. And we probably stopped raising rates about 24 months ago, you know, I would think. And so it's sort of just now starting to get into the system. And then, of course, we can always extend, right? So if you've got debt that doesn't work, give me another 6 months to work it out. And so it takes some time. So we're sort of like in this extend and pretend part 2, which Tom Briney just wrote an article about in our Market Monitor. And so we'll see how it falls out. But one of the things that we talked about in the Income Plus Fund webinar back in February was it's time to go on offense. And so we don't have any of this variable rate debt that people worry about. We're not over-levered. We don't have any distressed assets. And so we want to take this cash that we're raising in the Income Plus Fund, and we want to move to our first equity investments that we've done in the last 2.5, 3 years and find these opportunistic type, I wouldn't call them distressed quite yet, but opportunistic type of deals going forward.
And on the equity stuff, is that stuff that you guys would be owning and operating directly, or are you talking third-party stuff?
Yeah, it depends. I mean, if it's a real opportunistic development, we would, you know, work with a joint venture. If it's almost done, we could probably take the deal over. But if it's core, if it's a value add, or definitely if it's core, it's just something that we would buy and own and operate ourselves. We do all that in-house. Yeah.
Cool. Awesome. Well, I'll link to Origin's platform and the webinar if anybody wants to learn more about it. I think it's awesome. I'm really excited to be able to refer those farmers to Origin, so that will sell me their land, hopefully.
Yeah. I think it's a great strategy. And I will tell you that, you know, as far as this space where we're talking directly to sellers, this is relatively blue ocean. For the most part, if people hear DSTs, they'll say, I've heard of DSTs, the fees are too high. This is different. This is where we're taking the DSTs and you're getting into institutional pricing. So you're exchanging up into that higher quality asset without paying all those fees. And if somebody does give you that line, oh, the DSTs are too high, this is a new strategy, take a look at it for sure.
Yeah. Cool. Well, thank you so much. It was a pleasure.
Awesome. Thank you, Tanner. Appreciate it.